So handing him that check and him looking at me and said, like, this is life-changing for me. This was 20 years ago. This was life-changing for me. What are you going to do with the money? I'm going to pay down my mortgage and I'm going to have a college fund for my kids.
Welcome to the next episode of Grit Rising. Today, flew in from Miami for me, Jamie Elias from Trivest Partners. I'm going to have him give the usual explanation of his business and we'll get right into it.
Thanks, Trent. Jamie Elias, grew up in Miami. I work in the field of private equity, managing partner of a firm, Trivest Partners, in Coral Gables, actually. Came up through the accounting ranks, worked at Pricewaterhouse out of undergraduate, business school at Harvard, and joined Trivest at the bottom of the organization 26 years ago. And I love to surf and do outdoor activity, have a son and a daughter. Who are in the 6th grade and the 3rd grade right now.
Very cool. So private equity, when people know private equity, the first thing they think of is like they saw Pretty Woman, Richard Gere, like, he's buying companies, firing. In fact, I had this conversation last week, a very good buddy of mine who's like, private equity is just going to buy my company and they're going to fire all my employees and strip it down, sell it for its parts, as you would.
Right.
Can you demystify that a little bit?
I used to say to people who didn't understand what I was doing that, I do what Richard Gere does, but we're just nicer and know what we're doing a little bit better. That is, unfortunately, the view of many business owners. Their impression of private equity is negative, and if on a good day, it's maybe neutral. And so private equity refers to simply there are 100 times the number of private companies there are public companies. And so, hedge funds, when you hear the term hedge fund, they're buying and selling public company stock. So they sit behind a computer and they make a decision. They can buy and they can sell with a simple keystroke. When you're dealing with privately held companies, there's relationships and it's much more involved and takes longer to get a transaction done. But that view of buying a company and selling off the pieces, it makes for good television and movies, but it is not modern day private equity.
So my response to him was, most private equity guys know how to operate, but they don't want to operate. So the last thing that they want to do is fire your key people.
Correct.
You agree with that?
Yeah, absolutely. I joke with business owners that we don't have a roster of people, of business operators sitting on the sidelines ready to descend on your company to come and operate it. In fact, if we meet a business owner and meet some of the people that run the business alongside that person, and we don't think that they are talented and bright, we're not going to invest, because the last thing we want to do is bring in our own people to run the company. That is not the goal of our firm and many firms in the industry.
Yeah, and what's unique about what you said about the hedge fund buying public companies, the CEOs that I know that run public companies spend over a third of their time just dealing with investors.
Correct.
So you have
and there's an expense to that's millions of dollars a year of just being public.
Yeah, you have your most valuable asset or employee that just spends a third of his time just dealing with trying to make people feel good about a stock price from the next quarter just to keep his job instead of actually doing their job. So investing in private equity, you see why those returns are becoming more attractive versus all the costs that's dealing with public companies.
It's not every 3-month focus. Yes, we certainly track and monitor the business on a weekly and monthly basis, but even a fiscal quarter, a 3-month, is not enough time. We're typically going to invest alongside of a business that we like the industry and the people. And we'll sit and ask the management team, what do you think to really move the needle and get the business to the next level? And so we'll typically come up with what we call boulders, and we identify 2 to 3 boulders. It's so easy as a business owner or even in working in finance to kick pebbles around all year, right? You're just out there and you're doing stuff and you're calling people back. But we're looking at what are 2 or 3 things that we could do in this calendar year that we know 2, 3, 4, 5 years from now will drive tremendous value in terms of what the company is worth. And so when we get on the typically a Zoom call once a month for 60 minutes, that's the primary way we're interacting. Trivest does not take office space. We're not making hiring and firing decisions. Typically, you want me nowhere near a product planning meeting or branding. That's for the owner, the founder, and the management team to do. But we're very active on the sidelines, helping you with any resources you need to get where the business owner wants the business to go. We just help them get there faster than they might be able to do it on their own.
I love that, boulders versus pebbles. For us, we call it offense and defense, and we have to continuously tell people, like, what are the important things that we need to work on. Otherwise, you come in, you look at your email, and you just start reacting.
Right, exactly.
And moving pebbles around. The boulders are, what are the big things we have to do? And in fact, when we were talking the last podcast on Jet Zero, they talked about compressing months and weeks down to hours and days. And just how much faster when you are actually attacking something. So on that, as you're buying founder-led companies that are generally lifestyle companies, lifestyle being they're taking, instead of investing in themselves, they're taking money out of it. That founder that you decide to invest in, is there some common qualities that they have that you go, those are must-haves?
Yeah, I mean, working with a sense of urgency is one that is just highly correlated to success. The other is where the founder has effectively done every job in the company, and they are, they're technically many times the best person to do whatever functional area, but they've had to give it up over time as they scaled and grown the business. And somebody that can see the forest for the trees. Many times you get in a meeting with somebody and it's just they're not seeing the playing field. It's those founders that are able to say, the puck is going this way, and this is why we're skating to the puck. Because when we invest in a business, it's not only what is your company and what industry you're in right now, but we have to actually look out 5 and 10 years and say, if we invest money into this company, and in virtually all the cases, the founder is owning the business alongside of us. We can take a minority stake, meaning less than 50% ownership stake in a business, or if the founder wants to sell more, we'll buy more, and that's called a control stake. But if we're going to try to get money back to our investors, we need to do an assessment of what's this industry going to be like 5 years from now, 10 years from now. Is there something bubbling up on the tech front that will make the product or service less relevant down the road? And those founders where you get in the room and they're saying, I know where this industry is going, I know it better than anybody, and here's how we can win. That's where the excitement starts coming in. And last year we met over 1,000 founders, and so we're typically able to see it pretty quickly in an hour conversation.
So let's bring that to a granular level. You have 2 kids. You've met 1,000 entrepreneurs that you either invested in or didn't invest in. What are the 2 qualities that you want to take from all of that knowledge and create within your kids in terms of?
That's a good one. I think the first of all, integrity and ethics, right? We have a saying at Trivest, which is we don't like surprises, good or bad. And so get the bad news out, rush to problems. Most people, and so just even with my own kids, it's like, it's okay let's figure out the problem and help them work through a solution, which I think a effective founder is able to do, rather than the founder fixing everything all the time. It's great, and that's a great lifestyle business, but it's not one that you could see being double, triple, or quadruple in size over a 10-year period of time. And so, yeah, I think it's it's just good old-fashioned stuff, is work ethic, drive, ambition. And again, if we took our most successful founders, they tend to have these common elements and traits about them.
So the idea of starting and doing every job, I think, is unique as parents. My son, who just graduated Santa Barbara, and he goes to work as a mechanical engineer. His first 2 months he worked for this company in the port, and they treated him like he was busting rust off of boats. He was
right.
changing oil. He came home just covered in every day. And now I see him go to work, and he's almost embarrassed of his cubicle, because he's like, well, I don't want to be like, he knows all the yard guys now.
Right,
he knew he was going to move up, but those first 2 months were hell for him. But it's given him such a good perspective.
Right.
Like, I can see it as a father.
Yeah, my father was a physician, and this was not like something that, this was mandatory that I worked in the medical office. This is back when there was paper files, and I got paid like $4 an hour to file, and every day there would be a 2 feet stack of papers, and I'd have to look at the patient's name and then go find among hundreds or maybe 2,000 medical files. And that starting at the bottom mentality, I joke, even at Trivest, I'm still doing, entry level, which we call analyst type work. You have to be able to do everything from the easiest to the hard job, I think, to truly be successful as a founder of a business.
There's a ton of studies out right now that kids with chores over a long term are more successful, because they get confidence in terms of knowing what to do. Too many kids graduate or go on, and they don't have any confidence because somebody says go do something and they don't know how to do that.
Right.
So on one hand, we're trying to be the best parents and do things for our kids, and on the other hand, it's really important for them to start at the bottom, to do those little things that they have.
Yeah, our tendency is to be helicopter parents and bulldoze any problem in front of them, but ultimately it's not the best strategy, as difficult as it is to try to rein and hold back. But I've definitely, my kids are younger than yours, but I'm definitely trying to hold back more.
Especially for us who are problem solvers.
Right.
We see something, we're like, oh, well, here's the solution here. And adversity is so critical for them. So it's like sitting there and watching your kids fail and watching them hurt is one of the hardest things of parenthood, but knowing that that's ultimately their best recipe for success.
Right.
Like you talked about your nephew being the top sales guy at Crunch. That came from something.
Right.
Knowing how to ask somebody for money. My first job was a paper route, and the worst part about the paper route, or the best, was going and getting collections.
Correct.
Because every month we had to collect our own money. So you knew where a paper wanted to be. You knew like how you were going to get a tip and that sort of thing. And now you're in fundraising and that sort of thing. So being able to go ask somebody for money.
I used to ask people for small sums of money, and now I ask for large sums of money when I'm fundraising. But yeah, I had a college t-shirt business. I went to Boston College undergraduate, and in July or August every summer, I'd get a blank t-shirt. I'd go to a screen printer. My all-in cost was $3.70. And then I would be there when the parents were moving the freshman and the sophomore into the dorms. And the t-shirts were $10 or $12. And that was basically my spending money for the first and into the second semester each year. So I still remember those days of the car wash business and all these things that I used to do. I mean, my father was a doctor. It wasn't like we were, I grew up in a very comfortable household where we weren't, worried about money. But I don't know. It was just a trait that I had that I can't explain why. And, now I'm very excited when my My kids did a lemonade stand 2 weeks ago, and we worked on the concept of bundled pricing. So it was, you can get a lemonade for this, but if you buy the banana bread, it's a little bit better. And like they were really getting into it.
That's awesome. It's so unique to watch that. And today, a lot of times entrepreneurs or those that make it too good are chastised as if like they got lucky or whatever. But what I think a lot of America misses today is that $3.75 you came out of your pocket. If you sold no T-shirts, you just had a bunch of blank T-shirts that and so one, you had to come up with that capital, and two, you had to take risk on that capital. And so where does that ultimate reward? Does it scare you at all that companies are getting so big on the macro level, and then AI and all of their ability to say, like, if Amazon wants to go into the home restoration business, the amount of money, the amount of technology, the amount of resources they could put in that and lose in that field for a period of time until all the competition is gone.
Yes.
How do you as an investor in these businesses go, antitrust laws don't seem to be being enforced as much today. So how do we protect those businesses going forward?
Many times we meet with an unbelievable founder, great business, the financial statements look fantastic, and we ultimately can't get there on the investment because we are nervous around, we call it like the TAM, the total addressable market, or the industry, or you hear a simple press release or a news report of, Amazon getting into, healthcare, right? It causes everybody in our industry to say, like, let's take a minute, let's catch our breath and really get an understanding. And then we do intensive research on that. But you're right, it is nerve-wracking because we're investing in, quote, smaller privately held, but we're not investing in billion-dollar companies. We're investing in, companies as small as, $5 and $10 million of annual sales. I know that sounds a lot to some and small to others, but we're investing in good, solid, local and regional businesses many times, and it is nerve-wracking the amount that sort of the arms race in terms of how I never thought when I was a kid that I'd hear that a company had a enterprise value of $1 trillion. And now there's multiple companies that are worth more than $1 trillion. I didn't even know how many zeros it was when I was younger.
Yeah, it's insane. Let's talk a little bit about Trivest was control, and now you're starting to do some non-control, which means you're giving businesses money without being a boss.
Yeah, I mean, it's interesting. We were founded in 1981, have had a lot of success, and 15 years ago, 12, 15 years ago, there was a demand there was an interest from investors to actually give us more money than we were comfortable taking on. And everybody will smile, well, what's so bad about it? It's a good problem to have. But when you do that, you're forced to buy into larger companies because you have a set amount of time to invest the money. And so we looked and said, well, obviously we're not opposed to taking on more investment capital, but where are areas of unmet demand in our own business? So we have a lot of data, and we looked at those, 4,000, back then it was 2,000 opportunities came in, and we looked at the reasons why we were not pursuing, and two things jumped out. One was founder not ready to sell yet, and yet was the important point, or the founder wants to only sell 30% of the company, not all of it. And then another one was smaller companies, and that gave birth about 8 years ago. We decided to come out with something called the Trivest Growth Investment Fund. So in private equity, there are roughly 3,000 private equity firms, I think, in North America. And I would venture to say that 99% of that 3,000 firms all are trying to do basically the same thing, which is convince a business owner to sell them most of or virtually all of their business. the private equity firm buys 80, 90%, 95%, or even 100%. And we looked and said, well, there's a whole bunch of companies based on our own data that says good businesses, we liked them, they're in good industries, but the founder just says, I'm not ready to sell yet. And we looked and said, well, what's holding us back from just doing the same thing? And we went and looked at the market and realized that there was a huge opportunity because most of the people doing this type of investing are more like lenders, and they're more kind of banks or a credit orientation. And we went and raised a fund in 2016 called Trivest Growth Investment Fund. We refer to it as TGIF. And it was a fund of, it was over $225 million of money that we went and invested in 12 businesses around North America.
Those companies that you're buying, what do you think is the biggest difference between the person that breaks through $5 million and those that just stay at $5 million or less?
Yeah, I mean, the two most common traits that we see holding a business back, again, we're talking of a certain level. Let's say once they get past, $10 million in annual sales, is they never have enough salespeople, never, because, and I don't blame them, because a founder thinks like a checkbook, which is money in and money out, and I'm going to pay a salesperson, pick a number, $60,000, $70,000, $80,000, $100,000 a year, and this person's going to cost me money. They're not going to pay for themselves for a year or two. I'm not doing that. We have a longer time horizon, right? We can afford with our capital base. We think in terms of kind of 5-year blocks of time, and so. One is never having enough salespeople. Two is the finance and accounting department is typically 3 years, maybe 4 years behind the growth of the business.
It's non-revenue generating, right?
Yeah, it's non-revenue generating, and so my bookkeeper's fine, but the complexity of the business has increased, and the business owner doesn't have data at their fingertips. They don't know what their gross profit margin by customer is. They can't slice and dice the data like you would be able to if you had a competent person in that seat as either a VP of finance or a chief financial officer. And so, everybody's different. And then sometimes we meet the founders that totally get it and we come in and we're blown away. But by and large, I would say those are the two most common areas, which is just not enough salespeople, and they just don't have data. In our world now, there is an arms race with AI coming, and we're preaching. We have 52 companies around the U.S. and Canada that we have some ownership stake in, and we're preaching to these companies data readiness, because when we invest in a founder-owned company, we might invest and own 30% or 80%. That founder is still our partner alongside of us during the investment, and he or she is thinking about, we call it the second bite of the apple, which is, hey, I still own 40% of this company. What's that going to be worth down the road when Trivest comes and helps me transform this business in a myriad of ways? And so in order to get a premium valuation, the data requirements of larger private equity firms who we are typically selling to, sometimes a company in the same industry referred to as a strategic, will also, but they are all requiring to understand 7 layers deep of data, and 10 years ago, they were comfortable knowing 2 or 3 layers deep of data.
The salespeople, not enough salespeople, I think is unique because A, I agree with you. 2, most buyers or most founders had a salesperson that they tried to hire that was great in an interview that didn't sell anything.
Right.
And right, so they remember some of their...
Our data is, and sounds bad, but we tell the business owner, let's expect a 50% attrition rate in the sales people.
So how are you guys using behavioral analysis? Are you helping founders figure out how to hire a higher probability of a salesperson succeeding?
Yes. We have a group inside of Trivest called the Portfolio Support Group. And these people basically are a resource to a founder-owned company the minute the money goes in. And now they're getting ready before the money goes in. And they are helping in areas of human capital, revenue optimization, expense reduction, on and on. But yes, we've gotten much more behavioral psychologist around what are the traits. I mean, we have a lot of experience, but there are ways that you can catalog and perform an interview in a certain way. You're never going to be 100%, but like you can increase the odds that the salesperson is going to work out just by effectively utilizing basically industrial psychologist to have a 30, 45-minute conversation with a candidate.
That's good info. And then on the second one, where you say that finance is so far behind, obviously finance, right? It's trust. It's who's managing your money, the bookkeeper, the controller,
right.
Whatever. But a lot of times they lack the ability to forecast, or they lack the
right.
ability to say we should be spending more time here, less time there.
Right.
There's a very big difference between the reactive finance team and the proactive
right.
finance team. And so how hard is it for you to get a founder to say, I'm willing to let somebody else come in and...
Yeah, I mean, it's, we have to be experts in persuasion, just to be candid with you, right? Like, I think there's a misnomer of, these people are going to buy my business and do, mandate all this stuff. Even when we have a large percentage ownership, you can't force people to do stuff that they don't want to do. And so it starts even before we make an investment. And again, we have to evaluate, can we get along with this person? This is, like it or not, this is another marriage, right? If you take investment capital from a sophisticated institutional private equity firm, you have your marriage and then you have your business marriage, right? This is a business marriage. And we are candidly thinking about that, like, can we work with this person, right? You're having those conversations before you have the money, and it doesn't mean like it's like some of the stuff is saved for post-investment. But yeah, it's difficult for them to say, are you sure I'm going to spend this much more on a higher caliber person? How do I know I'm going to get the tangible benefits of it? The benefit of going with an established private equity firm is there's lots of other founders for them to talk to say, should I do this? Like, you were faced with a similar situation 2 or 3 years ago. And by and large, the feedback is, yeah, you should listen to these folks because it turned out to be a very good decision. One other thing before I forget, in terms of a trait that is correlated to success, most of our successful founders tend to have a frugality about them that was there when they started the business. And even when they have unbelievable wealth, they are still careful. And that mentality of not allowing creep in your selling, general, and administrative expenses, many times we'll go into a company, I can't raise prices, that's impossible. And then we say, did your utility bill go up? Did the lighting company? What about office supply? Oh yeah, that went up, that went up, that went up, that went up. Like, oh, well, that's not going to work longer term. And so it's be careful on expenses and think about ways to creatively offer something to your customers that delight them that you can get a bump up in price for.
And usually that frugality comes from somebody's, how they grew up, right?
Yeah.
Scarcity or whatever that may be. As we get into second and third generation, which is unique that you say that, because the statistics of a business making it to the second or the third or the fourth generation goes down exponentially.
Right.
Part of it is probably a little of that frugality, is that my dad came from nothing. His parents migrated here during the Great Depression. He was a baseball player that could sell.
Right.
And he's a great salesman. Where I had to really bring in value is I didn't have that pure sales part that he did.
Right.
But I also knew I didn't want to be sitting in a living room selling life insurance. It just wasn't, I wasn't good at it like he was. So I had to find my calling, if you will, and make our business a little bit more professional and that sort of thing. But that frugality, somehow he imparted that on me.
Yeah.
And now it's my job to impart that on the next generation. It's a unique balance, because on one hand, we want our kids to live a better life than we lived.
Right.
And on the other hand, you still want them to have that frugality. You still want them to have that work ethic, that starting from the bottom. And so,
I mean, the having your, like, the joy of climbing the mountain is much more fun than being on top of the mountain.
Yeah.
In my opinion, and I'm not saying that I'm on top of the mountain, but I'm not on the bottom of the mountain. And you think back and, like, all of the steps that you've done to get where you are. It's the journey is much more rewarding than, if you just take your kids and say, okay, you're here and you have everything, you live in this little protected bubble. I just don't think it's as rewarding.
Well, but now you touched on winning. You win along the way. You have these wins that you stack. And when you stack those wins, when you need the wins, it's such an adrenaline rush. Right. It's such a pump. When you're on top of the mountain, a win may or may not mean as much, but also you're not in the game as much.
Right.
You're coaching the game, or you're watching the game from.
We see a lot of founders ask me, like, there is a seller's remorse that sets in, right? It's, hey, it was much more fun building the company than. I tell business owners that the most anticlimactic day of their life will be the day that wire hits their account, right? If you got to me or you got to members of Trivest and we did our work and we're typically wiring extremely large sums of money, most of the time they're already financially well off, that, it's just, okay, the bank account number went up significantly, but there is a feeling, there is a little bit of a feeling of, oh man, what's next, right? And keeping them engaged in the company that they built, because they know it better. They know it much better than I will ever know it. That's our job, is to keep them engaged and excited about the business.
Well, it's like having another child, for me, a number, the insurance business, what the multiples they're paying are insane.
Right.
But I love it. And I literally, people are like, there's an arrogance in the world of the insurance business, which is like, they meet me and they're like, oh, you're privately owned, you should sell.
Right, yeah,
right?
exactly.
They say that, and I am always like, you've asked no questions about me, and you tell me that I should sell because you have somebody behind you that will buy. And it's crazy how prevalent that conversation has come, specifically from strategics. But the second part is like, I love it. Like, why would what am I going to do next? It doesn't change my life. The number is good, and maybe it takes risk off the table, but the wins, I think you hit on something. The frugality and the wins and the journey are so critical in anything. With athletics, with my running or anything, like, getting better is always the best part of the journey. Yeah,
I mean, as I look back on my career, most founder-owned business, it's owned by an individual, a husband and wife. That's most of the time. And most of the time, they have not figured out a way to get equity in the hands of the long-time employees. It's too complicated, and there's always these phantom this and phantom that. And so we're big believers in, hey, that next generation, right? Because you, the founder, you are going to be typically financially set for the rest of your life, and future investors, if you're still running the company, will look and go, okay, I don't know why he worked so hard when he was with Trivest. He didn't need to. But the next investor is just going to go, well, he's not going to work that hard. And so how do you bring up that next layer that is the future of the organization? And so we believe in like direct stock ownership into the company, and we have a method to do it. I don't need to go into the mechanics, but just know, like, the most rewarding day of some of the most rewarding days. Years ago, we invested in you might have slept on an aero bed one day, which is the inflatable air mattress. It was, we invested, and the warehouse manager, who was the best warehouse manager anybody had ever seen, had, I don't know, a $20,000 investment in the company. And I would go out, because the business was growing so fast, I would go out there and I'd be like, hey, Ben, how's it going? Like, what's going on? He's like, it's different now. And well, what do you mean it's different? And he said, well, I'm an owner now of the company. And it's $20,000, and we put in tens of millions of dollars. And, well, what does that mean to you? I asked Ben. And he said, well, I do more, I make the call at the end of the day. I straighten up a little bit more. I do this, I do that. And I was still doing it before, but I've upped my game, effectively, is what he said. It was a tremendously successful investment. His $20,000 turned into $120,000, a six-fold increase. And this was back in the day where you'd literally like have a printed check. And so like handing him that check, and we helped him with the $20,000. He didn't come out of pocket for the $20,000. So handing him that check and him looking at me and said, like, this is life-changing for me. This was 20 years ago. This was life-changing for me. What are you going to do with the money? I'm going to pay down my mortgage, and I'm going to have a college fund for my kids. And I can't thank I can't thank you all enough. Like, that's when you really get down to it, right? That's the stuff that I'm going to remember vividly, which is, and there have been literally thousands of employees at Trivest companies over the years that were employee stockholders of the business, and it's just a very cool and fun thing to be involved with.
Yeah, so often people quit who they work for. They don't quit for the money, or they don't quit for what it is. So I think your challenge always is,
right,
hey, we're now backed by institutional and investors, and we're private equity, and working for us may feel different than working for Tom, who knew his kids and the family picnic and all those things. And so it's a big challenge for you guys.
I mean, our mentality, and we say this in the first couple of meetings, is here's our mantra: if it's not broken, don't try to fix it. Like, most private equity firms are investing in well-run, growing companies. And so it does astound me that some in our industry, they can't help themselves but to kind of break it and try to build it back a different way. And ours is like, don't be a bull in the china shop. Like, yes, you can make tweaks here, and we can go and try to buy up some of the competitors. But fundamentally, we want our investment to be a one-day news story inside of the company. Yes, sometimes there's no press releases. The owner doesn't want an announcement. We're totally fine with that. And yes, everybody assembles in the conference room. Okay, what does that mean? And then that Friday, they get their paycheck. They're still reporting to the same people. We're not visible at the company. We're typically interacting only with the CEO, founder, the CFO, and maybe the head of sales, right? And it's a 60-minute Zoom call. We have 50 companies, so it's not realistic that we're going to be working 2 days a week at the company we just invested in. but we bring considerable resources to the table to help them, like I said, get where they want to go faster than they could do it on their own.
So you've had all this success. You've seen all these companies grow and do well. If you were to look at all those founders and look at all the exposure you've had to different people in your life, including your parents, who's like your hero?
I think it's more of a cliche answer, but I would probably say my dad, because it was like, it's a work ethic that I still don't even see today, right? Physician out the door at 6:30, doing rounds at a hospital, seeing patients all day, and then on the way home doing a house call for $5 or $10. Again, like I said earlier, concierge medicine before it was called concierge medicine. And I think every doctor secretly wants to be in business, and I'd say the vast majority of them are very poor at it.
Yeah.
And so, did I flirt with, wanting to be a plastic surgeon or something when I was a teenager? Maybe until I took 1 week of biology and said, no, this isn't for me. So it was just having that sort of that vantage point of, there is no substitute. Certainly, I think in your 20s and early 30s, it's like you just have to outwork everybody else. There's no shortcut to that. And I see now just where society is, everybody is looking for the quick money and the quick buck. I'm like, yeah, it takes a couple of decades to really hone your skills so you're in a position in your 40s and 50s to be like, okay, this is where the real money starts coming in.
So if your kids are sitting right there in 20 years and I'm asking them the same question,
I think it's interesting because there was some book where it said, like, for Father's Day, like, here's what I love about, and they had to write in like each page, and I was surprised, and my daughter was maybe 5 or 6 at the time, and a lot of her, things were the same things that I was thinking of my dad. It was, he works hard, he's dressed fancy for work. He works hard for the families. We take nice vacations because he goes to the office. She couldn't put it all together, but a lot of it was, kind of that work ethic, I think. That's cool. And I had no idea that was her perception.
It's got to feel good.
Yeah, absolutely.
So we end every podcast with, you get a question for me. So what's your question for me?
Oh, I get a question for you. I was going to joke and say, when are you going to sell your business? But I'm not going to say that. You are not too dissimilar from a private equity firm where you're constantly meeting, different businesses out there. And if you you've interacted, I had an investor ask me this question. You have probably seen thousands of businesses and business models during your time with the firm. What's the best business model or the best company you've seen that's a privately held business, if you think back over time and you go, man, this thing, based on what you knew of their operations, like what was the number one business you've seen during that time?
I don't know if it's the number one, but a theme is there are the people that have had the most success are generally in boring businesses.
Good answer.
They don't care about how many followers they have. They don't care about all that stuff. They're in boring businesses that do very well, and they figure out how to be the very best at their craft. Mm-hmm. I know for me, when I got out of college, my dad was in the insurance business. So I was like, well, that's not sexy. I don't want to be in the insurance business. So I went to work for Merrill Lynch, and I got thrown in their investment banking team in Silicon Valley, and that was exciting, right?
Right.
And I was going to be a financial advisor. I was going to be an investment banker. And then when I came here, I was having a child and that sort of thing. It was like, great, I got to tell my friends I'm in the insurance business,
Right.
right? And that was not exciting. But then the excitement came around how to be the very best at the insurance business, how to innovate, how to disrupt, how to do those things. So I'd say that it's usually somebody that's running a boring business that gets really passionate about that boring business. It could be a sprinkler head or something like just there's so many.
We joke that people ask, well, you have 50 companies, what's the common theme? And I say, well, first, it's the most boring, unsexy industries you can think of. There's a lot of essential services, and if you just walk around your house, right, and all the money you spend on your garage doors, your roof, your fencing, the construction site has porta potties. Like, we're in all of those businesses today.
Yeah.
And so, like what you said is, it's not like the flash and dash that makes the social media. Just good fundamental businesses where they outcompete and they're the best in that particular industry. That's highly attractive to somebody like our firm.
And I also think there's too much, I'll call it like excitement around like people thinking, oh, I'm just going to invest in a business and it's going to go. Like, you even talk about your portfolio team and how much pre-diligence you do. I think too many people go, I'm going to put money in something, I'm going to buy something, and then it's just going to make money.
Right.
That's fucking hard.
Yeah.
Really, really hard. And so they think, oh, I'm going to just do this and I'm going to be good at it and it's easy. And so business is hard. Business is hard. It challenges you every day, whether it's the politics of, for me, my the things that make me do not sleep at night are so the idea of socialism. Are we going to go to socialized healthcare, socialized retirement plans? The idea that the government can do something better than we can, when I know how passionate I am versus what the government employee may or may not be doing. And so those things challenge you and make you go, is this, to your first question, when you're ready to sell, my sell would be out of fear of that, which isn't a good thing, versus that check. It doesn't change my lifestyle.
Right.
So if it doesn't change my lifestyle, then what do I do? Now, growing the business, that's where I think the growth fund and that sort of thing is exciting, because you're like, all right, well, I want to grow, but I don't have $10 million to just go throw into salespeople. Right. That's that's possibly taking a step back, losing your house, losing all those things, and you get to those things, and you don't want to take those chances, and so it's a unique perspective.
Right.
So.
Yeah, and I'll just end with, I'm always like, at this stage, like, I like what I do. I don't have to be doing it. But my advice to any business owners that's watching is, don't squeeze all the juice out of the orange and then say, now I want to sell. Because any sophisticated investor will say, this is great, but you squeezed all the juice out of the orange. So, like, you constantly need to be planting seeds, at least, to sell, like, to the next investor, like, hey, you get and that's what we do from the minute we're investing, is we're figuring out where can we plant seeds, because we know we've got 4, 5, 6 years, and some of those are going to sprout, and that's what the next investor gets to enjoy as a way to make a nice investment return on their investment.
Yeah, that's great advice. Well, thanks for the time today.
See you.
I appreciate it.